Welcome to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
Thank you, intro man. Always starting us off so strong. He's remarkably consistent. I know you've noticed that James is a longtime follower of Punch Card Investing. But welcome to the show. We'll get into more about you, James, in a moment, for those of you who aren't familiar with your fine work in the value investing space. But before we get into today's episode, we're going to be talking about all things management and evaluating management, looking for red flags and all that sort of stuff. But before we do that, just want to remind everyone to subscribe if you haven't already, since we do put out a new episode every single week, or at least we try to. And most of the time we do get our weekly live show in, and we expect to have quite a bit more content coming out in the near future besides just our live show. And James, you might be playing a part in that since we've been discussing some of that stuff. But a number of people have come with some decent ideas on new content for Punch Card, and trying to really get the ball rolling with some of those extra avenues for growth on the channel. So really looking forward to that. So be sure to subscribe so you don't miss any of that. And check out all the other stuff in the description below, including our links to ShareSite and Seeking Alpha. You can sign up with a discount link through those links. So you can get a discount on the premium services, or you can sign up for the free versions as well. Just make sure to use our link, because if you ever switch over to a paid plan, then we might get a small commission, which would be really nice and would help out the channel a lot as we try to grow more and more. Otherwise, like, comment, subscribe, all that great stuff. Let's get into it, James. First off, welcome to the show. I don't think you've ever been on. You've never been on Punch Card at this point, because
no, that's the first time.
Because you're in Britain, and for those of you who don't know James, he is the man behind Firm Returns. I discovered you on Twitter. I believe you have a newsletter as well.
Yep.
And I don't know if you want to tell the folks a little bit more about yourself.
Yeah, sure. I mean, I've sort of started Firm Returns, I think, tail end of last year, maybe November, December time, and sort of slowly built it up from there. Kind of started off as just a way for me to do some extra due diligence and make myself a bit more publicly accountable for my investment decisions, stopping me from doing, higher frequency buying and selling, get a bit more conviction with everything. And it's sort of grown from there, and I've been able to make connections with people and learn from them, and I've kind of upping the due diligence further by attending AGMs, reaching out to management, what have you, that kind of stuff. And even had the CEO of one of my companies do an interview with me, so that was quite good. Yeah,
that's pretty sweet. That's the power of social media, right? So
yeah,
I mean that's how we met as well. So it's a very small world out there that's made increasingly small by stuff like Twitter, YouTube, all the great social media platforms where you can reach out to so many different people. So more power to everyone in that way. But yeah, so you put out a lot of good content on your own platforms. And you mentioned talking to CEOs and management directly, but I guess that's kind of a good parlay into our I should say, a segue into our topic of evaluating management. I don't know if you come into this with like a checklist or something when you're looking at stocks, but what are kind of some of the initial things that you might be looking for, maybe from a high level or even a more specific level when it comes to management?
Yeah, so I mean, I've got a few things written down here as prompts, but yeah, I've got I think largely the sort of setting the stage for it is I wanted to see some sort of alignment with shareholders, and that's sort of like the baseline, I think, for any kind of management to be really looking for when you're looking at their incentives and what have you. So I mean, I can sort of break this down to a couple of things. So one obvious one is that the management has a substantial shareholding of their own. So in some cases you'll have them where maybe there's a founder of the company and they'll have a really substantial stake, and obviously that's a thing. But in other cases where maybe there isn't a one large sort of shareholder in there, or the management themselves aren't the founder, and the founder's now just a member sitting on the board and the management, and they've recruited the CEO and what have you. I quite like to see, and quite a few of the companies I invest in have sort of minimum shareholding requirements. So they'll sort of say like a management has to hold at least 2 times their salary, their base salary or something like that in stock, which I always think is quite good. And then, another sort of aspect of that is that sometimes if you do have a founding shareholder that has a very substantial stake, and let's say maybe it's a family-controlled business or something like that, and they've recruited a CEO, it becomes slightly less important, I think, the CEO's holdings at that point, and then it's more about how they're incentivized, and that's where I'd get onto the second bit, which is incentives. So I like to see that a large part of their remuneration is performance-based, so they're going to earn, it's effectively variable. So depending on how well they do, there's not like a really high level baseline amount they get paid.
Sure.
But also when it comes to the actual metrics that are used to measure performance, I do generally prefer to see at least some per share metrics in there, because sometimes you can have situations where management will do will issue new shares to do dilutive acquisitions, because they'll grow the headline earnings figure, but on a per share you don't see the benefit. So that kind of stuff, those kind of targets to protect per share metrics can protect against that kind of thing.
And there's even within that though, there's still like I think timelines matter a lot as well. If they have to do a metric by a certain time period, they might sacrifice long-term output to try and pump up short-term output to get whatever metric that is. Even then, there can be some finer details to pay attention to, especially if we're talking about like stock options or anything like that.
And sometimes part of their remuneration is paid on depending on the share price, whether it's an option or sometimes even bonuses have like maybe a third of the component of calculating the bonus will be did the share price go above this certain value or something. So short-term things can affect that.
That can get pretty intense, just looking at compensation in general, whatever it's tied to, whether it's per share, which is probably better than not, but at the same time, is that per share metric in the next 3 months or in the next 10 years, so a lot of that can make a big difference, even at that level. So it's just kind of a very case-to-case thing, I would think, or certainly in some cases. So what else with compensation is there to look for? Because obviously we're familiar with stock options or stock-based compensation for executives, but there are kind of other things to look for as well. I'm thinking like certain benefits, like, expenses, private jets, traveling, all that good stuff that really isn't necessarily share dilutive, but is it's coming right out of the cash or whatever. It's still an expense that shows up. And any other things like that maybe to look out for?
Yeah, well, that's definitely a thing. I mean, it's not so bad. I mean, a lot of the companies I invest in are on the smaller side, so they probably couldn't afford private jets anyway.
But even then,
definitely something to look out for in those kind of things. And I think it can also be quite good when you're looking at like the performance metrics people have set to just have a gauge yourself and say, what's the threshold? What do they actually have to do to even start earning it? And then what's sort of the maximum there? So, and you really want them to be pretty stretching. Yeah. And I think you can also, something that's quite good when it comes to sort of evaluating management's past performance, that give you, I mean, this is something you can do manually yourself by just going back and pulling out various annual reports, but some companies will actually disclose like a table of like the performance for the last 5 or 10 years, how the management is actually, whether they managed to achieve their target level on the different metrics. And that can be a good exercise to do, just to see whether the target, if they've managed to do it easily, if they managed to hit the max every single time, that could either be, wow, they're a superstar CEO, or it could be, well, they've been setting them really easy targets here,
Yeah.
So there's a bit of a balance between those two. But yeah, that's probably what I would say on the performance side.
Yeah, Luis offers a good question here. Is there a company that you skipped because of the management incentive? It's weird to think of opportunities you've passed over, but I don't know if you have any that come to mind right away. But
probably,
yeah, go ahead.
Well, I think in a lot of cases, those are the ones that I probably would have passed on for valuation anyway.
Yeah, right. That's kind of what I'm thinking.
The overpriced ones, aren't they? That they get all the millions of stock options and what have you.
I feel like you only really get to, this is at least the way I would look at it, you really only get the management after you get past some of the baseline financial metrics. That's kind of how I operate. I look, first maybe at cash flow trends, historical financials before I really get into, the granular things about management usually, but there are exceptions. But typically, if it's going to be unusual, I think, that you're going to see a combination of like really good valuation and good financial metrics and everything, but with like terrible management incentives. Because usually it seems like a bad company will often have bad incentives. And
yeah, I think so.
Maybe that's an oversimplification and just like a selection bias thing, but that's a feeling I have. I don't know if you feel the same way.
Yeah, I think most of the companies that I've got past those first filters, that the management conversations normally ended up being quite rational, and I've been fairly happy with it, because it normally means the company's fairly well run. They've got a fairly good board and what have you, that's setting the conversation quite well, correctly. So yeah, I think those early filters can be something that screens out the before you get to the stage of skipping on companies because the compensation.
Yeah, you get to it either way. Like it's just when, and I don't know if I'd really count it as like management compensation, but just share buybacks in general. And that maybe this can be talking about capital allocation decisions with management, but share buybacks I feel like are kind of wrapped up into this as well, especially given like if they're compensated based on per share metrics. Retiring shares through share buybacks could be a way to manufacture some of that. And in some cases, share buybacks are totally beneficial because the stock is undervalued and they have excess cash to use. Then sure, it makes plenty of sense in a lot of those cases. But if the shares are expensive and you're still seeing huge buybacks, or worse yet, maybe the company's taking out debt to maintain a buyback program, that can be a big red flag too. So I assume you look at share buyback history as well with the management team, and I guess also any plans they might have. But I don't know if you have any thoughts on buybacks in general, or dividends.
So there are some of the companies I own. There are some that would be there is one in particular that's a bit growthier, and they do actually have a what they call an employee benefit trust, which is, I'll just start by saying that the options they're giving out are not egregious anyway, but they are effectively to prevent dilution. They have created this trust, which is effectively just it's more for the lower level management and sort of like maybe like the lower level share option schemes, people wanting to participate on an individual level and stuff like that low down in the company, rather than compensating for management being given big share options and so on. So that's
sure.
That is one example of one where it's been to offset dilution, but most of the other companies,
I think that's actually pretty common. Sorry to interrupt. That you see that a lot, where a company will advertise that we're buying back shares, but it's to cancel out dilution elsewhere, and it's okay on net you're not really doing anything.
They're pretty clear about it. They're not trying to say, oh, we're giving you all this money back or anything. They're just being quite clear up front.
But I think there are plenty of companies that aren't that clear about it, and it's easy to miss, especially just because share-based compensation doesn't show up on cash flow statements, generally speaking. So it's a very easy thing to overlook. a lot of the time. So yeah, but yeah, that is a good point though. Just you got to look at the whole situation on net to get a good feel for that.
Yeah, and I'd say most of the other companies I'm invested in where they have done buybacks, it's been entirely because they think the stock's undervalued. So, and it's been a way of returning capital to shareholders in a way. So, yeah, I wouldn't say I think any of the companies I've owned have done any kind of egregious stuff like that, like trying to just basically buying back their options and pretending that they're pretending it's some form of dividend.
I think they won't explicitly say it, but they won't really come out and admit it either. They'll just kind of be very quiet about it either way. But yeah, what about anything else on capital allocation in general? There's plenty you could talk about in there. I don't know what you think about dividends in general, but I wouldn't think dividends would be a red flag in general for management, but I think why is the dividend being given out? Is there really nothing else they could do with that capital? I don't know. Do you have any thoughts on dividends?
There's different ones. Like there's one company I own that's kind of a family run, well, basically family controlled company. And it's got a long history. You know, the family's basically had it for generations and generations, and it's kind of like the dividends are being paid out on just a regular schedule because that's how the family lives. So, you know, and then it's but it's also a lot of the shareholders that own it, and so I mean they have had there are, especially in the UK, there is a real attraction to shareholders to have. Well, it helps to keep the stock price up if they have a regular dividend schedule that's incrementally gone up for decades or whatever. I think this particular company I'm talking about has had like 70-year track record of dividend increases or something crazy like that. So it's it can be a nice market as long as the dividend cover ratio stays the same. It is kind of it is a good marker of a company that has been able to continuously grow its operations and earnings. So it can be.
That's a tricky situation too, though. Once a company has had a dividend for a while and they like kind of lean on it, I always see that almost like handcuffs, in that they feel like they can't really get rid of the dividend, and then if they do, you know, they're gonna have to answer to all these people. So I'm always a little skeptical or wary. At least a little bit of that sort of thing, just because of that. But I'd almost want to see that management has been willing to take a dividend on and off in their history, because then it shows that they're not just doing it just cause, but rather because like, oh, we have all this cash and not really much to do with it, and we've paid down debt, so here you go. Like I could get kind of behind that a lot more than just doing a dividend for a dividend's sake, if that makes sense. But
it does depend how stable the company is. Like if once it gets to a certain size, and then it is a case of we can't really do much. We can only reinvest so much of this, so a dividend kind of makes sense. Like I've got an example of a company.
That's pretty rare, though. I think that's pretty rare.
Well, I don't know. I've got an example of a company that's about 300 years old.
Yeah. Well, that's rare. That's what I'm saying. It's not impossible.
Yeah. True. Yeah, it's an insurance company in the UK called Aviva. I own, and it relates well to this actually, because during the pandemic, in 2020, because of the risk of increased insurance claims, they cut their dividend, and as a result, the stock price absolutely tanked. And that was I was lucky enough to spot it and dive in and picking them up. Realizing that it was a temporary thing and that it was very likely this dividend was going to come back. And I looked at it and went, so what would the yield be if it went back to its level of prior to the cut? And it would have been something like a 13% yield or something crazy like that. So nice. So I picked them up, the shares up at that price, and then of course within about 2 years it fully gone back up, and it's gone beyond where it was, the level it was before. So now it's
nice.
Yeah, the shares appreciate nicely. Yeah, so
it's so goofy why that happens. Just okay, the company cuts its dividend. I get that's going to hurt some people who rely on the cash flow, but even then, the company still has that cash, and you have a share of that company, so the value shouldn't be necessarily affected so much. But yeah, you see that so often when companies cut their dividend, people head for the hills. It depends on why they're cutting it, of course. If there is actual financial troubles ahead, that could be a big reason people are selling. But
yeah, I mean, it does create opportunities. Like, I mean, part of the reason that, for instance, Warner Brother Discovery is tanked so much since they did since effectively Warner Media was spun out of AT&T, was all the AT&T shareholders, which then ended up being majority owners of the combined entity afterwards, were largely holding AT&T because it was a nice dividend paying stock. And so once they realized, oh, now I've got these shares that don't pay me a dividend, it was that put a lot of selling pressure, and they just wanted to offload that, and they weren't really interested. So yeah, they just treated it in a way as like the actual shares were a dividend that they could just sell, and that had just been a distribution to them. So that drove part of the reason the stock price was driven down so much. So it does that kind of desire to have dividends, and I mean, it's certainly something when people get to sort of retirement age and so on, and they're wanting to just get an income, then obviously the dividends do make a lot of sense. So a lot of the holders, perhaps, of some of these dividend paying companies are people that would fit into that category. So it does create opportunities for people that are willing to look beyond just the dividend yield to the company behind it. Can create bargains.
I guess this kind of brings up something I've thought about before that I don't know how to feel about it, because technically, the board will have a fiduciary obligation to shareholders, but is it good or bad when management maybe ignores shareholders and decides to go with a rather contrarian decision that maybe benefits the company a lot more in the future, or is it better when they yield to shareholders when they want something? I don't know how to wrestle with that question, but I've thought of it a couple of times before, and I don't know how much weight to give it, if any. I don't know if you've ever thought of that. Just like,
well, I actually had a point on my list that was something similar to that. Does management listen and respond to shareholder concerns? Points I put down.
Maybe what I'm getting at is, are the concerns even valid? Your concerns are not valid.
Sometimes perhaps that is the case. Maybe that's a situation where the company needs a rotation of the shareholder base. Buffett wants only good shareholders that are going to be long-term holders.
Yeah, right. Get rid of the paper handers.
Yeah, not people.
Diamond hands only.
Certainly doesn't want people that want dividends, does he?
Right. Okay. Well, yeah. I guess that kind of addresses it. It really just depends on what the concerns are. That's more of a judgment call, really. Maybe I'm looking at some of my notes as well, kind of along those lines. What about you mentioned kind of going through the history of metrics they're hitting, but just strategy and implementing strategy, things like that. How do you even begin to evaluate that? Do you just look through old annual reports? Do you look at anything else? Just kind of on the strategy they have, are they executing it? And then using that to evaluate their strategy going forward, of course. I don't know if you have a process for that as well.
Yeah, well, I think that's definitely something that, there's a certain amount you can do beforehand, going back through old annual reports, like you say, going back through old presentations, what have you, just seeing how the company's strategy has changed over time. But it's another one of those things that, as they say, you start to get once you own a company and you continue holding it, you start to get to know these things more, and you start to see how management delivers over time, and it can either increase or decrease your conviction in your holding. So I do think sometimes that is something that you, as much as you can try and get yourself to that level of conviction beforehand, it's only really when you start to hold it and you're following it at the level that you will when you're actually owning the company that perhaps you start to see some of these things and how they really are delivering and how the strategy really is unfolding. Yeah, that's
the hardest part of our research, is getting interested in a stock that you don't already own. So it kind of helps when you do own it, at least a little bit. The incentives change when there's actual money on the line, and that's for better and for worse. Certainly a lot more emotions involved. depending on how stoic you are. Well, so then let's say you are holding you do buy in, you start evaluating management. What are you paying attention to exactly? Do you go back to an old report, look at their plan, and see how they did on this earnings call or something like that, or like, well, what are you looking at to kind of track that progress? Yeah.
I mean, a lot of it is just you can try and tell the story of the business, can't you? And sometimes this is something you can look back and you can try and look at their earnings history. Perhaps you can maybe look at the stock price movement and try and see. I like to go back and see what were the events that drove these things. So sometimes it can be good if a company's had a sudden drop in the share price at some point. Have a look around through news websites and stuff like that and see if you can find something from around that period that could have been some news that triggered it. Sure. And get a bit of a history of the company and how it's evolved, and then you can sort of try and put up a bit of a timeline as if you were holding it for that time. Something I've done in the past.
That's a good idea.
Yeah, and that just helps. It's good to get that picture of right. So how has management responded to these troubles in the past, and have they delivered and what have you? You can you can see all of that. The evidence comes in. Looking back at the financial results, did they recover or whatever? If the company had a fall, or did the share price recover as they started to implement whatever strategy they were doing, and shareholders rewarded them for it? Things like that can definitely be good things to try and get that picture build up.
Yeah. What about fraud? Do you even consider a manager who maybe has had fraud in the past, even if it was 10 plus years ago, a long time ago? How do you weigh that? Do you consider it? I assume you consider it, but how do you consider it?
Yeah, well, I've not encountered it with any of the companies I've owned, so I can't
that
say precisely. Okay, yeah, we're assuming that it's come to light. Yeah, I haven't encountered it, but yeah, I think it would definitely weigh in. I think that would be a case where, I mean, I've found it. Particularly when some of the companies I've had have been through real turmoil, it has been good to have actually, especially in the smaller names, which are normally the ones that are more volatile, it has definitely been good to have actually met management, to attended the AGM, spoken to them in person, whatever. And that's the kind of time where I think that really helps you to keep conviction with it and to really determine whether this person is trustworthy. And some of that kind of stuff is very hard to gauge from just looking at talks and things like that. So if it's not, I think the fraud angle is perhaps not something. I know there are big fraud cases and what have you, but
yeah,
with some of the larger companies, it generally the possibility of fraud decreases. So it's perhaps something on the smaller end of the spectrum that you have to do a bit more due diligence for. Yeah.
Well, I guess the question just slipped my mind, but I was going to follow up on that. But yeah, I guess. In actually meeting management. So I think Monish Fabrai has talked about it before, how you want to be very wary of meeting with CEOs, with executives, because they tend to be charismatic. They tend to really be passionate about their company, which is all well and good, but that can kind of can influence your judgment, your independent judgment of the company if they're very charismatic, if they're very salesy and all that sort of things. So since you've actually met some CEOs of companies you have invested in, how do you keep that in the back of your mind? Do you just kind of write it off? Is it purely a feel thing? How do you go into that?
Well, I think the most important bit is and this would make it a more, determines whether it's going to be a productive meeting anyway, is to have done most of your work on the stock before you actually attend and you actually meet management. So then you can ask much more, piercing questions. But it also means, you are somewhat, that sheen hasn't been put in front of your eyes before you start looking at the financials and stuff like that. So I do find that's probably the best step to have done that stuff. But it's also a case that you probably don't, maybe for the really big companies, that the management are more polished and they are sort of, much more salesman and what have you. I do find with the smaller companies, they haven't perhaps had the opportunity to build up that experience of being the crazy, good salesman and stuff like that. They're a bit more. They seem a bit more genuine from the guys I've spoken to. I don't think not that I'd ever get a chance to meet some management of the multi-billion-dollar companies, whatever. But
Sure.
But yeah, I think they would be much harder to read as people than they're much less open, because they've got that experience of doing a lot more public speaking with journalists and what have you, kind
Maybe.
of stuff. Yeah.
They're more cunning and clever.
Yeah.
Yeah, that's an interesting point. At the same time, like kind of some of these founder entrepreneurs, it's both good and bad. They're often singularly focused on the business, which is great for, they're going to put their effort into it, but at the same time, they're going to be very biased towards it, and anyone's going to be very biased towards their company, you would think. So I think just going in, I like your point about coming in researched, so at least you have some perspective, and if they say something that doesn't line up with your expectations, you're going to be like, what? And then maybe they address it. And if the addressing is BS, then you can move on or not. But maybe it's just it sounds kind of almost like a journalistic sort of value. You should know who you're speaking to before you speak with them, ideally, at least a little bit, ideally a lot bit. But and that'll probably save you from a lot of trouble, because you actually aren't going to walk over a minefield or get trapped into something that you weren't expecting. So
I think there are a lot of parallels between journalism and investing, actually, in terms of the actual research and due diligence process. Yeah.
Mm-hmm.
I think there's definitely a lot of the common skill set in some respects there.
Yeah.
So it's a good comparison.
Yeah. When it comes to research and I have like a history background, and it's a lot of the same stuff. You're looking at bias and things, my favorite Charlie Munger quote: "Show me the incentive, and I'll show you the outcome." It's kind of along those lines. If someone's biased in a particular way, they're likely going to say something that is within their bias. So if you can identify their bias, it makes the whole analysis a lot easier or more effective, because you know where they're coming from, or you know what they're trying to get to. And that's the same thing with journalism. You want to know what the bias is before you get into it. That'll make things a lot easier and more effective. Okay. What about some kind of great things you'd like to see? We've kind of talked a lot about red flags and general things to kind of watch out for, but is there anything that you see, if you see management doing something in particular, you're like, yes, that's great. I like to see that, and that's a great sign. Anything like that?
So what I really like to see is if I look at a stock and I think this seems like the natural path or natural strategy that management would take, if management then goes and takes that strategy, that's always a big green tick. And there's actually
complicate things.
Yeah, there's actually a company that I'm invested in at the moment, and the first thing I saw when I saw it, it's trading at something like I think about a 2/3 discount, or at least a 50% discount to book value, and it's all very tangible. It's all real estate, largely in London.
Okay.
So very, very high quality, and the business is very that's actually running it. It's basically a hospitality business. They have pubs and restaurants. So it's quite I would say you put it in the premium sector, which is why it's quite recession resistant, which is obviously part of it being in London, which is one of the most most expensive places in the UK and what have you. Mm-hmm. But it's you look at this and it's like their sort of strategy in normal times is to invest in trying to acquire, and they put something like, I think they do between 20 and 30 million pounds. So multiply that by 1.2 or something, 1.25 to give it into dollars. But and then they split that fairly evenly between doing sort of upgrades and what have you on the existing properties and keeping them in shape, and then the other half they'll be using to sort of expand and try and add capacity to the existing ones or to buy new establishments. Then I was just sort of looking at this and going, if the stock is currently trading at about 50% of book value, let's say, there's no way they could possibly find premium real estate in London that, sellers that would be willing to sell it for half of its value. So any deals they're doing to go and buy new properties are not going to be as good as buying back the stock. So surely it makes more sense to do that. And then lo and behold, at the AGM, they just announced they're going to do a share buyback program, and it will be about 1 million shares, which is probably going to be working out, depending on, it's fairly a liquid stock, so this price will move fairly quickly on it. But so they might not be able to, it might not stay at the current price while they're buying all those shares, but could work out to be sort of 5 to 10, roughly the money they would have spent buying new venues is now being spent on buying back the shares, because obviously they're immediately getting effectively a 2x on any investment they're making there, because they're getting twice the
alternative. Yeah.
So just seeing that was immediate validation. It's like a big green tick. Like, yeah, management is doing the right thing here. This is definitely the right action for them to be taken. So I think that's a big thing I'm looking for when it's sort of evaluating. Then you could just see
logical approaches.
Yeah.
Are they following a logical approach? Yeah. Okay.
Well, I've got a few more points we can touch on if you want.
Before we go for it.
So I mean, because we're just dipping back a little bit to negatives, perhaps.
There's plenty of those. So that's fine.
It's just so I've sort of said here, when you're evaluating performance, predominantly I'd like to focus on the underlying business. So, because that's something that they're largely in control of more than the share price. But contrary to that, if the share price has been depressed for a long period of time, that can be a bit of a warning, because if it's been depressed for a long period of time, management probably should have taken some action to address this, and they should have perhaps done some share buybacks or whatever to help pull the price back up to its fair value. And the reason it's good to do that, other than just shareholders getting returns, is that I see two ways that it's beneficial. If you have a higher share price, it gives management more options for potential merger and acquisition opportunities if they want to do deals in equity or whatever. But it also gives them opportunities to do, if the price does get above fair value, they can do equity raises, pull back some value effectively, and reinvest that in the business, and they've effectively got more value than they gave out in the shares, because they thought it was above the price. But then the danger is if you have a low share price, and this is something that, as I've learned from experience, I've been bitten by. If you have a company trading at a low share price, if it doesn't have certain protections like high inside ownership and stuff like that, like a controlling inside shareholder, for instance, it becomes quite vulnerable to takeovers, and takeovers can happen well below what you perceive to be fair value. And if the stock's gone down, that could actually end up being below the price you paid for the stock when you thought it was cheaper. So it is a real danger. And so the stock staying too low for too long, especially UK, it seems to be a real target for that at the moment. We've got a lot of US companies coming over and picking off our small companies at way too cheap value. So it's definitely something I'm wary about, and when I've been investing since, because I got stung by it with one particular company.
There's not enough runway or enough time for it to recover to what you think it should. If someone swoops in and gets it for well below that,
and you'll find that a lot of institutional shareholders really don't have conviction at all in any of the thing they're investing in. So they'll be as soon as things are looking a little bit rough, they'll immediately go, I'll take the quick exit, because it's probably just a small portion of their overall portfolio, because they invest in 100 stocks or whatever. They'll take the quick exit just to de-risk the position, even though it's well below the price it should have been paid for, and you don't have any option. You're just a minority holder that's just taken along for the ride, and the stocks effectively sold out from underneath you. So that is a big risk if stocks get too cheap. So a reason for management to try and keep the stock around its fair value if they can through buybacks or issuing new equity if it gets above.
Yeah, that's a good point. Yeah, the stock is too low for too long. It doesn't sound like it would be a red flag, but it could be for a lot of reasons. We talked about it a good bit on the value traps episode. We had Patrick and Tom were on that one as well, and that it's not even just like a management question, but yeah, asking why has the share price actually been down for so long? Is it because of mismanagement? Is it because of the industry being not so good? Is it because of the company not being so good? What's really going on there? And one area to certainly look into is management's reaction to it. I like that perspective on what are they doing to actually address it? Are they trying to do buybacks? Are they trying to do anything? I didn't even think of the acquisition getting acquired lens very much, because that is a good point for some of these smaller companies. Where a lot of us might be looking in this value world. So yeah, definitely a good point there. Oh, well, you mentioned a couple other things. What else were you thinking?
Yes, I mean, I think another one I had, which was just as a broader one, is something to evaluate management by is their relationships to their stakeholders. So I've broken this down into sort of employees, customers, suppliers, shareholders, and maybe wider society as well. So for employees, I've sort of said you can do things like, if a company issues employee satisfaction surveys, that can always be a good thing, but I don't, that's a company published thing normally. So you can put as much weight as that as you want into it. Yeah.
Speaking of bias, yeah.
But things like staff turnover rates are good things to look at if you can access them. Like I know one company I own has like a very low single digit staff turnover compared to like the industry average of about 15% or something. So that's always a good sign that the employees like working for the company. It's being well managed from that perspective. And then another thing to do if you can is a little bit of scuttlebutt, which would be seeing what past and current employee company, if you can find some forums. I mean, I know it can be a little dangerous looking at past employees. They're generally people that are going to have a more negative view, but if you can find current employees, that's always the gold mine. If you can reach out to people on LinkedIn or whatever, or if you just happen to, if it's a big enough company, you might end up just bumping into someone in daily life that works there or something. Or if it's a retailer or something, you might be able to go visit the store and speak to employees and so on. Yeah.
Quick point on that. This really is in this even smaller private realm, but just I was there was a company that was for sale in the Houston area that I was interested in, and I had I was looking at it and all that, and I was pretty interested. I wasn't sure if we're going to do it or not. And then an employee from that company applied to a job listing that I had opened like separately. And I'm like, oh, this is interesting. So I asked him, why do you want to, why are you applying to this job? Seems like you have a good thing over there. And he's like, oh no, it's a sinking ship. Like people are getting laid off and all this stuff. I'm like, interesting. Thank you for that note. But yeah, that it's just funny when he, that was kind of a happy accident, I guess, dodging a bullet perhaps. But
it would have been quite funny if you'd hired him and then he ended up working for the company he left.
Yeah, I had to be a little bit careful because of like NDA stuff. And if you're looking into business, you're not supposed to hire their employees. This is a little weird because he's applying to me, so I don't know how. I didn't want to bother with it, but it was still good insight either way. It doesn't mean I can't talk to him. But yeah, if you can get a current employee, that's certainly some valuable on the ground perspective in either direction, positive or negative. It's great if you find that they like working there. That's always a good sign, because it's definitely not a given that it's a good place to work.
Definitely, yeah.
All right.
So yeah, I mean, but then looking at like customers, there's various things depending on what the kind of company is. It might be something that you can look at reviews for instance, or customer satisfaction surveys or whatever. or you might be able to directly speak if it's maybe a bigger or a business to business company. You might be able to speak to some businesses that have had dealings with them in the past and get their views on them and so on. It could be a good thing to do, just to see how they're perceived. Like I was looking at a company in the UK called Halfords, which is like an auto repair company, stuff like that. And what immediately put me off was when I started talking to a few people, just people in my office and people, and then afterwards, once I got some negative feedback from those people all saying that it was a terrible place to go to and all this and it had terrible service, I suddenly went, oh, okay, let's have a look, see if I can find online, see what the general perspective is, and it seemed to be all very negative. So I was thinking, doesn't matter how cheap the company is, it immediately put me off when I sort of found that out.
Right. Yeah, when you get some case study individual accounts that line up with the general consensus, that's like that's not a slam dunk, but it feels like it.
It definitely soured it for me, even though on paper it seems quite attractive from a valuation point of view.
Right.
And then like from suppliers, so I mean, this is actually one point that's shared between perhaps customers and suppliers, and probably appeals to you, Jack, is are there any lawsuits outstanding for the company? Is that something to have a look into? Some of the bigger ones.
I'm sweating. So excited. But yeah, that's always that's a tough one, especially as the company grows, because it seems like there's always a lawsuit, whether it's frivolous or not. Do you look for a particular type of lawsuit, or just generally?
I think for me, it probably would apply more to things like, it depends what the lawsuit is, and it depends on the company. I mean, I've only
you're talking like an attorney.
Yeah, skirting around it. Yeah. There's only one company that's had a legal dispute, but they actually and it was a mining company, and it was I guess you would call it as a it was a mine that they had a royalty over, and there was a dispute over how much they should have paid and so on, and the royalty company that I own won the dispute. But that's probably the only one that I've actually had to deal with a lawsuit on that respect. But there are definitely when you get to the bigger companies, like I imagine if you're dealing with Microsoft or maybe any of the big tech companies, or drug companies or stuff like that, you're going to pharmaceutical companies, they have lawsuits left, right, and center, which is something that puts me off them. There's always that kind of risk there. I mean, I'm not a big fan of the pharmaceutical sector anyway. Just I've seen too many films of them. Well, this is where you get touched onto the wider society bit, where it does seem to be sometimes they choose business over people.
Well, I think but just backing up a bit, when you get to companies that are really large that do get lawsuits all the time, I think that at that point the bigger risk is just getting regulated out of something. But at that point, it's just a different ball game. You're probably going to have huge lobbying budgets and trying to, so they can draft that regulation for themselves and their competitors. But
absolutely,
yeah. I don't know if that's kind of in the ballpark of lawsuits, but you're really not going to see that in the micro cap and even kind of mid cap. You're not going to see that too much. It's really when you get up to the mega cap that they kind of are the market. You might see it.
And they are targets as well for a lot.
Yeah,
they become the bigger target for these lawsuits that may or may not be legitimate. Yeah, but
exactly.
But I guess on the smaller scale, it has a bigger impact having a lawsuit, because it could be something that could have a really meaningful impact on the company's financials and what have you, if they end up having to make some big payment. And potentially they've got a smaller customer base as well. So having a souring a relationship there with a big customer or something could have a big impact as well, or supplier. So I mean, on that subject of suppliers, I also put down here: do suppliers feel like they're getting a good deal? Has the company got them over a barrel? As like maybe Facebook and Apple might be a good example there, or like
is it a win-win?
Is it a win-win? Do they feel like it's a mutually beneficial relationship going on there? And or do they have a monopoly in this, suppliers just have to sell to them because they're the only customer or something like that,
Oh,
or one or two customers, or
that's
or
kind of
vice
nice
versa.
to have, though, if you have an actual monopoly.
Yeah, but it is something that if it's not a positive relationship, then it does mean that the suppliers would be potentially happier, or the customers would be happier to jump ship if a competitor came up, rather than if you've got. So it makes them more vulnerable. The moat is more vulnerable to somebody
competition
crossing it. Yeah, competition, because the competition wouldn't have to be that much better. They could potentially it might have to inconvenience the supplier, or the customer, but they might still go to them just because they've been getting a bad deal, been treated badly by the other company that had the monopoly.
Yeah, you might call it. I like to call it kind of commoditized businesses, where you don't have much of a moat, and often it's just kind of whoever's fastest and cheapest is who's going to get the business. So if either of those breaks down, it's too expensive, or it's too slow or whatever, then anyone else who can do it faster, maybe they run leaner, they have better technology or software to run it faster. That's a huge threat. So yeah, that's a good point as well.
And something else to be a little bit, sometimes people, from like the cash flow statement point of view, it can look a bit positive if payables go up, because this is referring to suppliers again. But if the payables go up, it means that they've been able to delay paying the things, and the difference between them and the receivables can be positive in the short term for cash flows. But I do feel sometimes that can be a little bit of a warning sign, because it can mean suppliers might be getting pissed off if they're not getting paid promptly and what have you. So that can be a little bit of a warning sign as well. Are the working capital being managed correctly?
That's a good one. I haven't really thought of that one before. Yeah. Are they being paid slower than before, or just slowly in general? Kind of reminds me of Patrick on the Value Traps episode pointed out Intel with their inventory skyrocketing. If you see a bunch of inventory building up, begs the question, why is management trying to build up a big inventory for something for some reason, or is it just because sales are dropping? What's actually happening? It's I think it's pretty closely related to the receivables being delayed.
I think so, yeah. And then, the last, so we kind of touched on the wider society ones of regulation and impact and so on, but then shareholders, I was sort of saying, we touched on this a little bit as well, that when I said, does management listen to and respond to shareholder concerns? But there's also things like, are management open and transparent with it in their dealings with shareholders? Do they try and hide bad news from them, or are they pretty, when bad news has come along, have they been upfront with it and things like that?
That's a tough one, though. That's a really tough one to figure out, because if they're hiding it,
but that's something that, looking back in history, can be good. Like when the stock has had, you can look to see back see a point where earnings fell or something like that, and see, right, let's have a look at the reports around that time. What were they saying? Things like that. If they were trying to sweep it under the rug and saying, "Oh, it's all macro, it's all wider economic things every time," and not taking any responsibility, then that sometimes can be a bit of a bad sign.
I think that's a good way to put it. Are they taking responsibility for bad things? Yeah, I like that.
Yeah, and I think that's. I know the final one I might say on that is, what do shareholders think of management? And this is a pretty easy one. It's debatable whether this is something you should listen to or not, because if you wanted to be a contrarian, then potentially you want to be taking if they don't like management or they don't like the company, maybe that's the time to be diving in. But yeah, that's something that's pretty easy to get a gauge on as well, because plenty of shareholders on social media shouting loudly. So
I don't know how much weight I would give that, but I think it comes back to kind of the logical concerns or not.
And it can be a bit of a warning if you have like, in the case of like Tesla, for instance, Elon Musk lovers, Elon Musk fans, they do that can be something a bit of a warning sign, maybe.
Yeah, it's a flag, we'll say. Flag to take a look at, but it's very situational, I'd assume. But yeah, kind of goes to the general sentiment as well. Okay, well, I guess think it's a pretty good spot to wrap up on it. We covered.
I think we've got.
I was going to.
We might have a couple of questions here.
Yeah. Yeah. One of our Luises asked, "How many people are considered management? Just the CEO, CFO, the whole board?" I consider the board and executives. So pretty much everyone that would have a higher level decision to make. Sometimes that's just a few people. Sometimes it's a whole board. I think it depends on the company and what executives have what power. Some of them will have a lot more. Take Mark Zuckerberg as an example. He has all the voting shares, so tons of power flows through him. But take a look at some other companies where power is kind of diluted a lot more. They could be totally different. I don't know if you think of that any differently.
Yeah, I mean, it really depends on, like you say, the ownership. Like sometimes you'll have a board, and maybe the chairman of the board is someone with a really massive stake in the company, like maybe even a majority ownership, and then the CEO and CFO are people that they've recruited to do the day-to-day run the day-to-day operations for them. And that in that case, they'd be particularly important, I think. And generally, I would definitely include the chairman in when I'm considering people. That maybe the non-executives I wouldn't factor in so much into because they're not so involved in the day-to-day running. But yeah, chairman is important, and definitely the CEO and CFO and any other members of the executive team. So companies have all sorts these days: marketing officers, commercial officers, everything.
Sure. Yes. All right. Well, thank you for the question, Luis. And then here's one for you, James, from the other Luis again. Do you invest in Chinese companies? People love to ask about China here.
It's an interesting one, actually. My wife is Chinese, and I do actually I visit China quite regularly with her. So I potentially would be a naturally good fit for investing in the Chinese market. But I feel in some ways it has it scared me off a little bit, my experiences of visiting there. So, and I think as well, for me, it's more the way that you have to invest. The thing that puts me off more, I think, in China is the method by which you have to invest, going through these remote entities, and you're not really controlling the shares and things like that. That's probably the biggest thing that puts me off, rather than, I mean, the Chinese companies, I'm not got a problem with them themselves, but that thing, just that little bit of a chance of your shares just being taken away, and are you actually going to get the return, given the company's earnings and what have you, it's just a little bit of a factor for me that stops me. But yeah,
even true love couldn't bring you over the line.
I don't know. Maybe it would be different if my wife opened up an account in China, for instance. Being a Chinese citizen, and she opened up a brokerage account there, and she could directly own them. Maybe I would consider it. Maybe that's something I would consider in the future, especially if I did spend some time living there. But I would struggle to do it myself, doing it remotely, because they don't provide easy access to the markets officially.
Right.
For foreign shareholders. So yeah,
I think that's a fair take. Interesting, regardless. Yeah. Okay. Well, and anything else then to wrap up on? I don't see other questions. But thank you to everyone who's participating in the chat, especially the Luises. You guys carried a lot of the first half. But anything else on this topic of management or anything else?
No, I think we've covered it pretty exhaustively here.
Well, I think there's more we could go into deeper, but yeah, but this is a good survey of kind of just a bunch of things to look out for on the positive and negative side. I think if there's a key theme or takeaway, it seems just like logical decision making. Making logical decisions and whatever it is, whether that's buybacks, whether that's strategic initiatives, whether that's not doing something versus doing another thing, whether that's listening to shareholders or not. If it's logical, then probably be in a good spot, and if it's not logical, then who knows. So yeah. Well, thank you, James. Appreciate you coming on. We'll have to have you on the live show again if you're willing to return, and I'll see if we can get some of the other members to come as well. I got to throw old man Tom under the bus. He said he'd be here, but it's early in the morning from him. He's got a young baby. I don't know. So we'll see if he's on next time. But Thank you for doing this one with me, and thank you everyone else for stopping by the show. And be sure to subscribe if you haven't already, so you don't miss next week's and all the other content we're going to be putting out. So with that said, until next time, everyone, see you.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.